Today I will be presenting our comprehensive financial ratio analysis comparing AirAsia Group per head and the Malaysia Airlines per head, also known as MAB over the period from 2022 to 2024. Okay, so let me start with slide 1, our introduction. This analysis focuses on two major players in Malaysia aviation industry, AirAsia as a low-cost area and MAB as a full-service airline. We chose these companies because they represent different business models in the same industry, allowing us to make a meaningful comparison. Our aim is to assess their financial health using key financial ratios based on data from their official annual report and relevant industry benchmarks. Now moving on to slide 2, the industry overview. In 2024, Malaysia's aviation sector showed strong signs of recovery. Passenger traffic reached about 89% of pre-pandemic levels, mainly driven by demand from China, India, and the Middle East. However, the industry still faces challenges like fluctuating fuel prices, labor shortages, and supply chain issues. These factors directly affect cost control and profitability for both airlines. Let's look at slide 3, the company profile of AirAsia. AirAsia was founded in 1993 and is currently the largest low-cost carrier in Southeast Asia. So in 2024, it recorded 22.5 billion ringgit in revenue and 1.35 billion ringgit in net profit. This was supported by a strong load factor of 83%, which means seats were well utilized, and an impressive ancillary revenue of 2,253 ringgit per passenger. From services like baggage fees and seat selection, their fleet includes 18 Airbus A330 aircraft, and they are ranked among the top 15 global airlines in ESG performance. Now on slide 4, we discuss Malaysia Airlines per head or MAB. Founded in 1947, MAB is Malaysia's national airline. In 2024, it earned 13.679 billion ringgit in revenue and achieved a net profit of 540 million ringgit. However, it operated 6,000 fewer flights than the previous year due to capacity constraints. Despite these challenges, MAB invested in fleet upgrades by introducing Boeing 737 MAX and Airbus A330neo to improve fuel efficiency and customer experience. Finally, let's go through slide 5, where we examine their liquidity ratios, which measure a company's ability to pay short-term debt. First, the current ratio calculated as for AirAsia, it is like in 2022 it's 4.1 billion divided 3.8 billion equals to 1.08. So in 2023 is 1.16. In 2024 it's 1.34. So we can see that AirAsia's current ratio is improving each year. A ratio above 1.0 means the company can cover its short-term obligations, and by 2024 it is close to the LCC industry benchmark of 1.3 to 1.6. For MAB in 2024 is 1.31, While this is acceptable, it falls below the full service carrier benchmark of 1.8 to 2.2, which suggests MAB might have some liquidity risk compared to peers. So next is the quick ratio, which refines this calculation. This removes inventory from the equation, since inventory may not be easily converted to cash. For AirAsia in 2024 is 1.29. For MAB is 1.28. So these figures show both companies are managing their liquid assets efficiently. AirAsia's slightly higher ratios reflect stronger short-term financial health and good inventory control. So that covers the first part of our analysis. In summary, both airlines are recovering well in terms of liquidity, with AirAsia showing steady improvement year over year, while MAB is maintaining stability but still falls short of its industry benchmark. So yeah, that's all.
First, liquidity ratios, they show if a company can pay short-term bills. The credit ratio is current assets divided by current liabilities. For AirAsia, it went up year by year, 1.608 in 2022, 1.16 x in 2023, and 1.34 x in 2024. MAB's 2024 current ratio is 1.31. The quick ratio is similar, but takes out inventory. AirAsia's 2024 quick ratio is 1.29. MAB is 1.28. Both are close, which is good. Next, asset management ratios. They tell us how will companies use their assets. AirAsia is 59.3. MAB is 96.7. A higher number means in sales faster, but MAB's higher number because it has less inventory. AirAsia's is receivable turnover. AirAsia is 20.93. MAB is 17.1. This shows how quickly they get money from customers. AirAsia is a bit faster here. Then debate management. The debate to assets ratio shows how much of assets are paid by debate. AirAsia is 17.2%. MAB is 16.7%. MAB has less debate compared to its assets. Profitability ratio are key. Gross profit AirAsia is 20.89%, which is good, but MAB is 5.99. That means its costs are higher than revenue from sales. Net profit AirAsia is 6%. MAB is 0.39%. AirAsia makes more profit from each ringgit of revenue. Market revenue ratios, P ratios show how much investigators pay for each unit of profit. AirAsia is 6.17, MAB is 6.67. PB Ratio compares stock price to assessed value. AirAsia is 1.16, MAB is 0.77. Lastly, DuPont AirAsia of for ROE return on equity is combines three factors. AirAsia's ROE is 18.8% strong. Thanks to good perfect assessed use and smart leverage. MAB's ROE is only 1.64%. It's needed to better in marketing perfect and using assessed.
DuPont Analysis 2024 ROE equal to net profit margin multiply total asset turnover multiply equity multiplier. The AirAsia company NPM equal to 6.8%, TAT equal to 22.5B over 25.7B equal to 0.875x, EM equal to 25.7B over 25.7B minus 18.5B equal to 3.57x. ROE equal to 6.0% multiply 0.875 multiply 3.57 equal to 18.8%. MAB company NPM equal to 0.39%. TAT equal to 13.679B over 21.1B equal to 0.648x. EM equal to 21.1B over 21.1B minus 12.8B equal to 2.54x. ROE equal to 0.39% multiply 0.846 multiply 254 equal to 0.64%. Current ratio 1.07 to 1.31. Quick ratio 1.03 to 1.28. ROA negative 6.15% to 2.56%. DOE 2.55x to 1.54x, TAT 0.54x to 0.648x, net margin for negative 11.43% to 0.39%. This is MAB trend analysis 2022 to 2024. This is a peer comparison summary 2024. Recommendations for AirAsia: lower leverage slightly to reduce risk. Target EM 3.0x. Enhance ancillary revenue via digital channels. Bridge PRE gap through investor communication. Recommendations for MAB: urgent cost transformations to address negative GPM, improve TAT via fleet modernization, rebuilding investor trust through clear recovery roadmap.